Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In my years of being involved in the equity markets, I've experienced many major corrections and few of what can only be termed as crashes. It is my experience that the big market moves downward have been the result of markets suddenly realizing that a major underpinning of their expectations was based on a false belief. Suddenly a market development, a report, a statement by someone who should know triggers the shock that they and everyone else was wrong. The shock spreads like a wave through the markets, which then react with everyone selling and no one buying. The misbalance and urgency to correct portfolio positions results in a get-me-out-at-any-cost as the market accelerates lower, called a capitulation. This is what I want to discuss in this session. There is a growing chance that markets are currently operating on a mistaken belief. As such, I want to discuss the subjects outlined here. Before we talk about what that false belief might be, let's talk about the precarious position the market now finds itself in, a position that is unfortunately ripe for something to take it into a major tailspin. I've showed this chart a few times lately to illustrate the seriousness of the current market predicament, where something to be able to cause it to tumble lower in quite a dramatic fashion. The trifecta points out both how rare it is to have these three events potentially occur simultaneously and the historical results of such an occurrence. They are extremely narrow breadth that has taken the market up in a parabolic or geometric lift. 2, a pattern of a double top which has developed over the longer term. And 3, a recession occurring as the outside strength or second top is put in place. The combination is proven to be extremely problematic for the equity markets. To say that current market breadth is narrow is almost an absurd statement, realizing the degree such has occurred. The Magnificent Seven stocks now completely dominate the U.S. and even the global equity markets. We have seen this before in the 1970s with the Nifty 50 and during the 2000 dot-com bubble with the major internet providers. But the current situation has taken it to another level. Will markets in general and U.S. technology growth stocks in particular continue to party like it's 1999? And are we headed for a 2000-style crunch? In the late 1990s, the story was that the internet was going to generate exceptional earnings growth for companies in technology, media, and telecoms. The bubble inflated until by the early 2000s, the prospective earnings yield on U.S. growth stocks was pitiful, both in absolute terms and when compared to the real yields in U.S. fixed income, whether bonds or bills. The valuation gap was just too great, and the market started to have doubts about when clicks would be converted into actual revenue. The market was forced back to the realization that fundamentals really do matter. With that, the bubble burst. Fundamentals are again in such a position, as is the trifecta. So what could go wrong? The list is longer than most realize, but there is one that to us stands out. On the inflation front, the increasing risk is that the January uptick in U.S. CPI and PPI inflation, along with the year-to-date rebound in oil prices, is not just noise, but the start of a reversal from last year's disinflationary trend. Any more upside surprises in the inflation data will make the Fed more cautious about the timing and pace of rate cuts, because inflation remains the principal consideration determining Fed policy. If the Fed keeps short rates elevated while continuing quantitative tightening, the relatively high real yields on bonds and especially on bills could begin to weigh on U.S. growth stocks. If inflation surprises on the upside and the Fed confounds expectations for rate cuts, T-bill and chill will likely prove the investment strategy of choice. The Federal Reserve has been consistent in its message that we should expect the Fed funds rate to remain higher for longer. Their message has been clear, but the reality is the market doesn't believe them and is trading against what they are telling us. Everyone has bought into the belief that the Fed pivot is a foregone conclusion, and though it appears not to be about to occur in March as originally expected, less than 90 days ago, the most feel it will occur by June or July. But what if suddenly everyone realizes that inflation is not beaten? It is still very much alive, and rates will not only be higher for longer, but in fact may be headed to slightly higher levels. Now that would be a market-moving shock. But is that even a real possibility? Many feel that with rates so high, something somewhere will break. This is what has occurred many times previously when the Fed raised rates and the Fed was forced to pivot. But will this be the case as usual? We saw when we had a banking crisis last spring with the collapse of the Silicon Valley Bank that the Fed didn't take down rates, but rather targeted its focus on a specific facility called the Bank Term Lending Program. It therefore avoided a pivot. Wouldn't it do that again if it had the choice? A severe recession, many say, will also cause the Fed to pivot. But in the last 3 to 4 months, the thinking seems to have subsided, with the belief that we will have a soft landing or no recession at all. Why? The Financial Conditions Index is easy, and for those paying attention, even the Fed's own charts on the subject show it has always been easy throughout the period of its quantitative tightening program. What gives? Investors are finding out that liquidity is simply not in short supply, even with bank credit tightening. This many find confusing and futilely try to explain it. We've shown for some time now it is the result of a number of factors, including stealth liquidity programs we have laid out many times since last June's debt ceiling increase. Clearly, to many, the disinflationary downward impulse we have been experiencing has run its course. In fact, we are now seeing signs of inflation once again raising its head. Is it possible inflation is not behind us, and in fact, more of it still in front of us? Is there a chance there is no Fed pivot coming, or at least not as currently expected? This would mean the markets have been wrong. Their belief has been false. Their portfolio position is wrong. Higher rates, or even higher for longer, is not good for equity markets. We should expect wholesale disruptions if that were to happen. Let's talk about whether that is realistically a possibility. We should be asking, why are 5-year inflation break-evens now rising strongly? Why are 2-year inflation break-evens also rising right across the yield curve? Historically, the Fed always follows the 2-year yield, which the banks and debt auctions determine. This says the banks are signaling to the Fed rates are headed higher. With the 2-year break-even ramping again, this also suggests this may be the 1970s type of inflation if the manufacturing industry does not get stronger. And judging from the most recent ISM numbers, the fiscal money being spent is not helping much in that way at all. The 3-month core PCE, which includes supercore, seemingly turned the corner recently. If this is good inflation type, then it might be like the 1940s where increasing services inflation, wages, are accompanying people working to rebuild the country. This means real wages continue to grow above trend, warning of a wage price spiral if people spend instead of saving. This is what we are seeing, actually. We have long suggested that inflation moves in mysterious ways, and specifically in waves. We saw it in the 1970s. We saw it in that 1930s to 40s period. We've seen it recently when we look at it closely and compare it to the 1966 to 1982 period. We've been suggesting this for some time, and in fact outlined it in our 2023 thesis paper, The Great Stagflation. What everyone may be currently missing is that the U.S. is a services economy. It isn't a manufacturing-dependent economy as it once was. Services are obviously hugely important. It's where the consumers spend the majority of their money. Many services are essential to modern life, such as housing and related services, healthcare, insurance, broadband, telecommunications, auto repair, transportation, etc. It goes on and on. Inflation is notoriously hard to eradicate from services. Service inflation is almost entirely a function of domestic economic activity. The Fed has to get that lower, but it appears they can't. Inflation in core services is tough to beat, and it can dish up big head fakes, a fact that Powell has mentioned a few times now, hence the Fed's wait-and-see approach. Last time this type of core services inflation occurred in the 1970s and the 1980s, there were clear signs that inflation was cooling sharply, and we thought repeatedly that the high interest rates at the time had beaten inflation back down, which caused the Fed to ease, only to find out that we had fallen into an inflation head fake, and then the Fed jacked up rates even further. I lived through the 3 waves. I personally felt it and experienced it in my professional life installing computers at the time. The head fakes occurred over the 15 years between 1966 and when core service inflation finally peaked at 11% in 1981. So this is the core services PCE price index, which excludes energy and the oil price shocks at that time. The upturn is also occurring in the heavily services-oriented Eurozone. Over the past year or so, the Fed has been intensely discussing inflation in core services, which is where inflation has shifted to in 2022 from goods inflation, which had spiked in the mid-2022, but then cooled dramatically. So core services is where it's at. Core services are where consumers spend the majority of their money. Core services are all services except energy services. Core service inflation has been behaving badly for months now, and in January it spiked significantly. The core services PCE price index spiked to 7.15% annualized in January from December, the worst month-to-month jump in 22 years, the blue line here. According to the index data released recently by the Bureau of Economic Analysis, drivers of the spike were non-housing measures as well as housing inflation. More in each category here in a moment. The 6-month moving average, which irons out the month-to-month volatility, accelerated to 3.95% annualized, the worst since July, after having gotten stuck at the 3.5% level for 3 months in a row, shown here in red. The bad behavior of core services inflation that we have been lamenting since June, and which was confirmed earlier this month by the nasty surprise in the CPI, is why the Feds have said this year in near unison that they're in no hurry to cut rates but have taken a wait-and-see approach, and now the concept of rate hikes is cropping up in their speeches again. For example, Fed Governor Michelle Bowman said in a speech a few days ago that she was willing to raise the Fed funds rate at future meetings should the incoming data indicate the progress on inflation has stalled or reversed, end of quote. Even year-over-year core services inflation has now reversed and accelerated to 4.1%. So let's look at the 7 core services categories. Core services without energy services, such as electricity, are grouped into these 7 PCE price indices, and we'll look at them individually. This is where consumers do, as I said earlier, the majority of their spending. The month-to-month data in these categories of core services can be crazy volatile, blue in the charts here. So we'll focus on the 6-month moving average, which irons out this volatility and shows the recent trend, that is red in the chart. Housing inflation is hot. The PCE price index for housing accelerated to 6.4% annualized in January from December, the worst of September in blue. The 6-month moving average, which irons out the month-to-month volatility but still shows the more recent trends, accelerated to 5.7% annualized, having now been in the same range since August, shown in red. Housing inflation has backed off from the crazy spike in 2022 and through February 2023, but then it just got stuck at this hot level of 5.5% plus and has refused to cool further and seems to be re-accelerating now. The housing index is broad-based and includes factors for rent in tenant-occupied dwellings, imputed rent for owner-occupied housing, group housing, and rental value. Financial services and insurance. It's up 17.2% month-over-month annualized, shown in blue, plus 5.5% 6-month moving average annualized. 3rd month in a row of acceleration, shown in red. Food services and accommodations are up 8.25% month-to-month annualized, and 4.0% 6-month moving average annualized, the 2nd month of acceleration. Healthcare is up 3.5% month-to-month annualized, shown in blue, 2.4% 6-month moving average annualized, and roughly stable at this rate for the past 5 months, shown in red. Transportation services is up 0.4% month-to-month annualized in blue, 3.2% on the 6-month moving average annualized in red. This includes motor vehicle services such as maintenance and repair, car and truck rental, and leasing, parking fees, tolls, public transportation, from airline fares to bus fares. Recreation and services, up 4.6% month-over-month annualized, 4.9% 6-month moving average annualized in red. This includes cable, satellite TV and radio, streaming, concerts, sports, movies, gambling, vet services, package tours, repair and rental of audiovisual and other equipment, maintenance and repair of recreational vehicles, etc. All the things we regularly consume. Other services are up 9.4% month-over-month annualized and 2.1% 6-month moving average annualized. A vast collection of other services where people spend lots of money on, including broadband, cell phone, and other communications, delivery, household maintenance and repair, moving and storage, education and training across the board, professional services such as legal, accounting, and tax services, union dues, professional association dues, funeral and burial services, personal care and clothing services, social services such as homes for the elderly and rehab services, etc. I go on with this list. Really bring home, this is everything we do. Whatever we're looking at, this is really where we spend our money. So the core PCE price index, which includes core services plus a non-energy goods, accelerated month to month to 5.1% annualized, the worst in 12 months in blue. The 6-month moving average accelerated to 2.5% annualized. Certainly something to really keep an eye on. But we are seeing even more warning signs than just inflation as it currently is measured. How about things that could drive those individual line items in inflation? The economy is not slowing. It's reaccelerating. Growth expectations for 2024 saw a big jump following the Fed pivot in December and the associated easing in financial conditions. Growth expectations for the U.S. continue to be revised higher. Following the Fed pivot in December, the labor market remains tight, jobless claims are very low, and the wage inflation is sticky between 4 and 5%. Surveys of small business show that more small businesses are planning to raise selling prices. Manufacturing surveys show a higher trend in prices paid, another leading indicator of inflation. ISM services prices paid is also trending higher. Surveys of small businesses show that more small businesses are planning to raise worker compensation. Asking rents are rising, and more cities are seeing rising rents, and home prices are rising. The S&P CoreLogic Case-Shiller Home Price Index has also started to lift. Financial conditions continue to ease further, following the Fed pivot in December with record-high investment-grade issuances, high-yield issuances, IPO activities rising, mergers and acquisitions activity is rising, and tight credit spreads in the stock market reaching new all-time highs. With financial conditions easing significantly, it is not surprising that we saw strong non-farm payrolls and inflation in January, and probably should expect the strength to continue if reported properly. All this suggests that there is a strong chance the Fed will spend most of 2024 fighting inflation. As a result, yield levels in fixed income will likely stay high and may be, in fact, forced to be increased, a problem. So, what can we conclude? I spent a lot of time in 2023 explaining the Volcker miracle that beat inflation of the 1970s. It wasn't raising of interest rates. That was actually a reactionary function that helped, but wasn't what stopped it. His miracle was about reducing liquidity, which he did as shown in the red box here. By keeping it managed properly during the 40 years since, we had the Great Moderation. Unfortunately, all those hard lessons were thrown out with COVID as an excuse to literally send liquidity through the roof by spending $6 to $7 trillion. If for no other reason, this is why inflation will return in our humble assessment. In the near term, we need to watch services, as explained, very closely. The key indicator to consider is the blue line, which represents fluctuating business costs of the service sector. This line serves as a robust leading indicator for inflation trends. Its ascent in 2021 accurately preceded the surge in inflation, and it also forced the subsequent decline in 2022. Currently, the blue line hints at an incoming inflation uptick, indicating rising business costs, which often lead to price hikes that fuel inflation. With lots of other bearish signals, as shown here, also clearly visible, it wouldn't take much to cause a stampede. When markets are at highs, most are already in the market, Who's left to buy? Like a theater, when everyone is seated and someone yells fire, getting out becomes a real problem. We highlighted a number of major macro issues in our recent videos. These all need to now be taken into careful consideration. It may be time to take risk off the table. The last 5%, as I've continued to remind you, usually turns out to be the most expensive. As I always remind you in these videos, remember the politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day, fortunately, is still in the future, so take advantage of the opportunity as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So when we talk again, may 2024 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.